we'll talk about politics. Let's finish with this on stablecoins.
Yeah.
That seems to be what they're going after now in their crosshairs. Again, Gary calling them poker chips. New York Times article yesterday said 75% of all transactions are with a stablecoin. And again, it seems like the direct threat to the bank deposit. Tell me about stablecoins. They didn't really exist a couple of years ago.
No, they didn't.
Now
it was
they
only
are.
Tether, and now there's a bunch of them.
And a bunch of them, and they're the highest volume instrument traded in, in the blockchain. And they're probably the reason why so much liquidity is here. And now it seems like they will be the first regulated focus. Because Bitcoin, I had Michael Saylor on the show, and he's got $5 billion of Bitcoin on his public, company balance sheet. And he said, I like Bitcoin because it has low aspirations. Bitcoin's not trying to change centralized finance. All it wants to do is to store value. It's not going to be programmable. And I'm happy to invest in it. But the stablecoins, they are trying to eat the lunch of CeFi. So
right. Well, a couple of thoughts. Now, first of all, those being called poker chips, it's not a legal category. That doesn't mean anything. The more interesting thing is that Gary Gensler considers stable coins to be a security. And in the United States, not to get too technical, but there is a test on whether something is security. It's called the Howey test.
Yeah.
Everybody in crypto's heard about that.
Tell us about it.
It is whether it is a common enterprise for the profit, for profit, by efforts of others, and with the expectation of profit.
Of a yield, or profit, or
for
return.
Profit,
okay,
for return.
Okay.
So, and it has to tick all four boxes.
To be considered a security.
Yeah, but it can be three of them, and if it's not the fourth one, or either one, if it's not, then it's not a security. Now, how exactly do you expect to profit from a stable coin if it's one-to-one packed with the dollar? I understand why Ethereum might be, or some of the tokens, because there you have a company, it's putting in the work, it's the infrastructure, you expect to make money, but something that's pegged one-to-one to the dollar, there's inherently no expectation of profit. Right. So that is a curious thing to say, but ultimately at the end of the day, the authority of what's security and what's not a security is the SEC, and if you disagree with them, you got to take them to court. And I'm not gonna do that personally myself. I was hoping that perhaps Coinbase might dare, but it will appear they're not gonna do that either. So
they might.
They might. The other thing that's curious is what you said. You're trading out of the market. You want to trade out. You go into stable coins. Early on, during the 2017 boom, you were trading the different assets. And your base currency was always Bitcoin. That was one of the reasons why we saw the huge run up in 2016, 2017 when volumes picked up and people used that as their currency of account. Now that is stable coins. And then the other thing is that you see a lot of trading in markets that don't have access to great banking systems, or have currencies that are prone to debasement, printing, like in Zimbabwe or Nigeria or even Turkey, quite frankly. There's inflation fears that are running wild and they come to fruition. So, you have something like the border of China and Russia where they do trading in stable coins now. And I understand why this might be of concern, but banning it outright doesn't solve the solution. I mean, the number one currency of choice is the United States dollar, and more often than not, large-scale money laundering occurs from the banking system. We haven't thought about, abolishing the dollar and the banking system. So applying that to crypto, how does that solve the problem?
Yeah, if you look at most of the money laundering, it happens where most of the money is, which is in the banks, especially the ones that pay the fines every year, like HSBC, for all their money laundering violations.
No, but you nailed it here. It's about the incentive. As long as you can make $10 billion as a banking institution, and then you settle with the DOJ or whoever for a tenth of that, and there's never been criminal prosecution, or hardly ever, it's all civil, what exactly is the incentive for you to stop?
Yeah. I think Brian was just saying that 1%, I think, of all crypto is attributed to money laundering and illegal dealings, whereas 3 to 4% of the US currency is considered in that as well.
I'm sure there's money laundering in glasses, drinking cups, people having 0.1% of all transactions being done in something that's not even money.
And also the majority of stablecoin trading is probably taking place outside the US anyways. So you'd be always curious to see what would happen. Let's just finish off with best case and worst case scenario, say 12 months, 18 months from now. Say Gary just goes crazy and decides I'm just going to take all these people to task, or Gary just decides to take a snooze for a couple of years.
Yeah.
Like, what do those two realities look like for us in crypto?
Well, let's start with the worst of and on a positive note. But I think they're very focused on the earned products. They're not concerned about the other aspects, even though some currency exchanges I'm going to face some challenges because, I'm going to get too technical again, but very briefly. But I think it's interesting. I don't know. You'll tell us after how the viewers are viewing. But, with current, there's so many tokens that you cannot go after individual tokens. You cannot go, there's 5,000 probably right now. So any regulator has limited resources. So what they're doing, or appear to be doing, they're focusing on the trading venues and saying, we're not going to go after XYZ coin, but we're going after you because this might be security and you're trading securities and you don't have the license to trade securities. So this has been sort of, because Brian and Coinbase have been so vocal about the land product, this has been pushed back, but it's very important because that might come back to bite us. And in the sense that venues might get shut off, just trading activities. They have to register SEC, registered broker dealers. We, by the way, are buying one in the United States. So
that's how they'll stop the trading of it.
Yeah.
They can't actually go after the coin, so they'll go after the on-ramps.
Exchanges, on-ramps.
Yeah. And that's where
that has been in the speeches, but it hasn't taken the headlines. It's the lending product. But it's curious to see, and that could affect negatively in the midterm, short to midterm, and then we'll figure it out. Everybody is going to get broker licensed, or trading volume will go offshore. That's the downside. If you keep innovation out of the States, it just goes somewhere else. It doesn't disappear. And then the other thing would be, I think this will have more repercussions for the general public. They wouldn't have access to high yield earning products. So it will be a net loss for the customers and the clients and the investors and the consumers themselves more than the companies, because the companies, they worst comes to worst, they'll need to pull out of the United States. But I don't think that something has been done so terribly wrong to, have criminal indictments or anything like that. At least for the vast majority. Clear scam and frauds, yeah, but this is not the industry as I know it.